The story of the 2008 crisis begins long before the crash. It begins with a dream that every American could own a home. Banks loved this dream too, because every home loan meant profit, and profit meant growth, and growth meant greed. By the early 2000s, interest rates had dropped sharply. Borrowing money became cheap. People rushed to buy homes. Investors rushed to buy mortgage-backed assets. Banks rushed to approve loans. And slowly, quietly, dangerously, a bubble began to form. But this wasn't an ordinary bubble. This was a bubble built on risky loans. Loans given to people who could barely afford them. These were called subprime mortgages. Banks didn't care if people could pay or not, because banks weren't keeping the loans. They were selling them. Wall Street firms packaged thousands of these risky loans together. They created something called mortgage-backed securities. They sold them with AAA ratings. Ratings that claimed that these investments were completely safe. But they weren't safe. They were ticking time bombs. Investors around the world bought them. Pension funds bought them. Governments bought them. Everyone believed American real estate would never fall. But real estate always falls eventually. And when the first cracks appeared, nobody took them seriously. Homeowners began missing payments. Foreclosures started rising. Banks ignored the warnings. They kept pushing more loans. More risk, more danger. This was the calm before the storm, and in that calm, one giant stood at the center. Lehman Brothers, a 158-year-old financial powerhouse. One of the biggest investors in mortgage-backed securities. One of the loudest believers in the housing boom. One of the biggest risk-takers on Wall Street. But behind the scenes, Lehman was drowning. Their assets were collapsing. Their loans were failing. Their debts were skyrocketing, and yet the firm insisted everything was fine. But everything was not fine. Lehman had built an empire on unstable ground. And when the housing market started slipping, that empire began to shake. The warning signs were flashing red. But the world did not know what was coming next. Nobody realized that the collapse of one bank would shake the entire global economy to its core. By 2006, home prices had peaked. Then they started falling. Slowly at first, then faster. People who took risky loans could no longer refinance. Monthly payments skyrocketed. Defaults exploded. Foreclosures spread across the country like wildfire. Each foreclosure pushed home prices even lower. And every drop in price destroyed the value of mortgage-backed securities. Investors panicked. Banks panicked. But the damage was too big to stop. The financial system was infected. Every major bank was exposed. Citigroup, Merrill Lynch, AIG, Morgan Stanley, and especially Lehman Brothers. Billions of dollars were evaporating. But the world still hoped the crash could be controlled, until one shocking day. September 15, 2008, Lehman Brothers declared bankruptcy. It wasn't just a bank collapsing. It was trust collapsing, confidence collapsing, the illusion of stability collapsing. Markets reacted instantly. Stock markets around the world plunged. Trillions of dollars disappeared within days. Investors were frozen in fear. Banks stopped lending to each other. Credit markets froze. Businesses couldn't borrow money. Families couldn't borrow money. The global economy came to a standstill. The housing crash had now become a global meltdown. Governments were terrified. If banks collapsed, people's savings would vanish. Companies would shut down. Millions of jobs would disappear. And the world could fall into another Great Depression. So governments stepped in. The US launched a massive bailout program called TARP. Hundreds of billions of dollars were pumped into banks. AIG received the biggest rescue in history. The Federal Reserve slashed interest rates to nearly zero. But despite all efforts, the damage was enormous. People lost homes. People lost jobs. People lost life savings. Millions were pushed into poverty. The global economy shrank. Stock markets crashed. Countries across Europe faced severe recessions. Iceland's banks collapsed completely. Greece spiraled into debt. Spain and Ireland saw housing markets implode. The shockwaves from the US rippled across the entire planet. And as the dust settled, one truth became clear. The world had been living inside a financial illusion. An illusion built on toxic loans, false ratings, extreme greed, and a belief that markets never fail. But they did fail. And the entire world paid the price. After the crisis, everyone began asking one question. How did no one stop this? The truth is, many saw it coming. But few had the courage to speak. Economists warned about the bubble. Some bankers raised alarms. Even government officials expressed concern. But profits were too high, greed was too powerful, and the system was too blind to its own weaknesses. Financial institutions were making billions. CEOs were earning fortunes. Investors were enjoying years of incredible returns. No one wanted the party to end. But it did end, and the crash forced the world to confront hard truths. Truth number 1. When something looks too good to be true, it usually is. Truth number 2. If banks take unlimited risks, ordinary people pay the price. Truth number 3. Markets only work when trust is real. Not manufactured. Not exaggerated. Real. The crisis also exposed how deeply connected the world had become. A housing crash in one country could destroy economies across continents. A single bankruptcy, Lehman Brothers, could freeze the global financial system. It proved that modern finance is powerful, but dangerously fragile. In the years after the collapse, governments changed regulations. Banks were forced to reduce risks. Financial reforms were introduced. But even today, many experts believe another crisis is possible because the root problem never fully disappeared. Human greed. The desire for profit at any cost. The belief that markets can be controlled. History shows they cannot. And the 2008 crisis became a brutal reminder. When greed becomes strategy, collapse becomes destiny. But this story is not just about numbers. It's about people, families who lost their homes, workers who lost their jobs, students who graduated into a recession, retirees who lost savings built over decades. The crisis didn't just break banks. It broke lives. And yet the world rebuilt. Slowly, painfully, brick by brick, economies recovered, businesses reopened. New rules were added. But the scars remain. And the lessons remain. The biggest lesson of all? When financial systems forget humanity, humanity suffers. Today, more than 15 years later, people still ask, could we have prevented it? The answer is complicated. But one thing is certain. Understanding the past is the only way to avoid repeating it. Because crises don't happen overnight. They grow silently. They grow slowly. They grow in the shadows of greed and denial. And by the time the world notices, it's already too late. If you want more powerful financial history stories like this, make sure to like, share, and subscribe. Your support helps this channel bring the past to life. One story at a time.